Stocks finished the week flat, about as flat as you can be. We were up. We had some up swings early, but very small swings, and a small swing lower at the end of the day to finish flat. Now the Russell didn't finish flat; it finished down 1%. The Nasdaq 100 was up a little bit, so not everything was as flat, but most everything had very small ranges, very small compared to already extremely small average ranges. So that's probably a precursor of what we're expect to see over the next couple of days as we head into a very important FOMC meeting Wednesday. Because again, is this Wednesday going to be just a one-time, maybe 2-3 time cut? A mid-cycle adjustment like we saw at the end of last year, like we saw in 2019, like we saw in 1995. Those are all instances of just like mid-cycle adjustments. In 1998 as well. We saw one during that correction of 1998 in response to that correction. So all of that, right? All of that, is that what we're going to get? Because that typically is really bullish. Or is it the start of a more indefinite, consistent cutting cycle, which in the past, again, has not been so bullish for equities? And, again, we'll talk about, what we expect to see going forward and some long-term. I've shown you a couple red flags here this week that aren't necessarily imminent, but this is something to pay attention to and what they might lead to. Today's video, since it's a weekly chart, I'll show you a couple of long-term red flags that, again, aren't necessarily imminent as of next week. Even post-FOMC, I don't think we're going to get like a 5% decline. I'll show you why and how much I think will, if we drop, how much will drop. But the long-term red flag suggests that, if we do rebound and continue higher, how much longer and what could happen once we do turn. And that's the big concern from a long-term perspective. So we're going to break all that down. What's moving the markets today from an intermarket standpoint? Of course, the big thing to watch, a big signal in bonds. I'll show you what I'm talking about there, and gold, as well as telling us something that we might not be willing to pay attention to. And then our sector rotation was back to normal today from what we saw yesterday, along with the breadth indicators. So then our trade idea is a bullish trade again, but not in your typical sector, right? It's a sector that may be able to still move higher regardless of whether we're bullish or not by the end of next week. So let's go ahead and get started. Today is Friday, September the 12th, 2025. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. You can join our website at MarketScholars.com for free and get access to our Market Outlook blog post every day. It's a quick review, one-stop place. You can see exactly what happened, why it matters, what to watch for the next day, as well as our Market Outlook preview video is free as well on that blog post. Again, you get that with our basic subscription. Follow me on Twitter at DavidSettle42 for more content in between the videos, and join our Market Outlook Facebook group that we've created. If you're on our website here, again, you can get to access to our Market Outlook videos at the top of our page, all our archives, and that gets you sent here. You can see all of the Market Outlooks every day. Again, if you click on one and you're not subscribed to the site, you have to have just a free basic subscription. You can see when you go to our pricing plans here under pricing, you can see our free basic subscription gets you access to our Market Outlook. So you just have to subscribe, click on that button there to log in. And then once you do, to get your account, then you can just click on the login here button. Get you access again to a full review of what happened today. Again, why it matters. And here's the Market Outlook preview, all for free. If you want access to the full version, you click on the upgrade to Foundation. It takes you to our Foundation page. Again, for just $29 a month or $2.99 a year, which is 2 months for free, you get access to the full Market Outlook videos, the Market Outlook Live, the trade tracker, all the blog posts, and anything else that comes along with that basic subscription. And again, here's where you can do that. Again, you can do monthly or get 2 months for free with our yearly subscription. All right, let's go ahead and take a look at the S&P 500 with the market forecast indicator here. You can see we finished slightly lower. We were just in a really small range all day today. 20-point range was it. So really, we finished near the lows of the day. Despite that, after being up for most of the day, a little bit of a drop here, just a small late drop you'll see here in a second. Despite that, the intermediate line is rising in the upper reversal zone. The market sentiment line is rising in the upper reversal zone. The near-term line is rising in the upper reversal zone. I mean, very strong bullish trends from all these different time frames. The momentum line was down, but mainly it was down. It was down when we were up today too. It's down just because it's such a small range, and that happens. We talked about that in last night's market outlook video, where the momentum line drops whenever there's such a small range there, and that's what we got right now. So that nothing significant, and not oversold, not extremely oversold, and not even oversold at all. It's in bearish territory, but we've seen lots of dips in the bearish territory, and that's just led to moves to the upside, as you would expect to be the case again here going into next week. You can see again strong near-term push on the near-term line, so the Nasdaq 100 did finish higher by 0.5 percentage point. The intermediate line's above the 90th percentile again. Remember, it was above the 90th percentile for the longest time. It's very rare to be above it at all, and it was above it for pretty much most of this rally until just recently, and now we're back above it again. The near-term line is also up above the 90th percentile, so strong move there after not being so strong previously. And then, of course, again, the momentum line dropping because of the small range, about 100 points less than. Remember, this is extremely low ATR, so if you're below that ATR at all, you're extremely low in the range, and we're significantly lower than that ATR. Let's take a look at the Dow Jones Industrial Average, and you'll see, okay, we had a little more of a down day, down 0.6%, but the intermediate line is still strongly bullish. Market sentiment is rising again. It had been falling, obviously, as you can see, the orange dotted line, but it's now rising. It's turning back up above the 77th percentile, so working its way. The intermediate line has been above the market sentiment this entire time, so it's that's a strong bullish posture. And then, of course, your near-term line's up, but it's not in the upper reversal zone yet. That momentum line that was overbought yesterday, we talked about, most likely would drop today, and it did. And it actually did include a little bit of a decline. So a little bit of weakness there, but nothing like we've seen down days, and every down day we've had here lately, we responded with bullish days. And again, that would be something you would expect to see going into next week. Your Russell 2000 was down the most. It was down 1%. Remember, it was such a big catch-up trade yesterday in the broadening trade that went the other direction today. So we'll look at that more obviously in detail too. But your intermediate line is above the 90th percentile. The momentum line, which was so overbought yesterday, dropping back down again. Number one, because we fell 1%, but number two is because we're significantly lower than what is already an extremely low ATR. So with all that in mind, nothing significant. The near-term line can still actually move up higher. The momentum line can bounce out of this bearish territory. So I expect that we should probably get, again, a little bit of a short-term bounce in like the Dow and the Russell into next week, with the S&P and the Nasdaq continuing their bullish moves. Let's go back to the S&P and take a look at the weekly chart, and you can see we finished the week with a cluster. So this is the third cluster we've gotten since we've started this bullish rally off the April low point. Out of the three, this one's unique in that we have a green dot. Now we got a green dot over here on this cluster, and we went up. It led to an intermediate decline, but we went up. We had two small down weeks and then two up weeks that were also pretty small, and then we had our intermediate decline. So it doesn't mean necessarily we have to falter here. And again, over here we had some clusters with green dots right there, and in 2020 and then 2021, and then another one right here in February of 2021, and yet we continue to move higher there. Now, a little different scenario because 2021 was such a high inflationary time that everything was going up that was denominated in dollars, including stock prices. So a little different scenario here that, again, the dots on both, and you see that the Nasdaq 100 also getting a cluster, not in the 90th percentile, only the 81st, We were so bullish here coming off that low in 2023, about 18% above the 30-week moving average, and right now we're only 12%. But still, pretty strong cluster pattern again. If you look at the Dow Jones and the Russell, it's a little different scenario, not getting a cluster. Strong intermediate posture, but the near-term line down and more neutral, and the same thing with the Russell 2000, right? Again, it's getting up to all-time highs, but not quite there yet. It's been a nice good run. The weekly chart is strongly bullish in terms of the intermediate posture, crossing above market sentiment. Everything looks good there. It's just not as like, I guess you could say not as parabolic considering. But again, you are 12% above, and even that's only the 63rd percentile. Like, back over here in the reopening trade, we were so strongly bullish, but that was a unique time frame. So if you look at like, where's 12% related to everywhere else, it's actually pretty high. 74th percentile, but it's really high. The only other times we've been higher is the reopening trade here, and then the move coming off the bear market low there. Let's take a look at some of the other weekly charts. Again, we got a cluster on the weekly chart. We got a strong Hakinashi candle, and we're trading, over 40% above, or 40 points, above the Hakinashi close. So we should start the week with a bullish Hakinashi candle next week too. And then we'll see whether or not it ends up being a higher close. I mean, we did get a higher close this week and a higher high. You can see the size of the body here is above its moving average. We're still rising above the 5% mark on the PPO. So remember, the PPO measures the gap between these two lines up here, and that gap is still getting bigger. So it's a very good sign in terms of the strength of the bull market. The other weekly chart we've been looking at is the whole. And this is still a little bit of a red flag. Again, we're so bullish here. The parabolic SAR has been coming up, but we've been slowing down, and the parabolic SAR is getting really close. And you notice we're not very far above the 200-week moving average. So if we got a pullback right now, most likely we would break the 200-week. And we usually only break the 200-week, when you are, breaking down below the 5% mark. We're above 5%, so we're okay. But still, we'd be very susceptible to a correction because that's what happens when you break the 200-week hole, is you have a correction. So that's something to keep an eye on here next week, that we maintain the bullishness, because if we flatten out next week, maybe get a lower Hakinashi close, then that would lead into a transition candle the week after, which can be bearish, and that would probably be the week that would be very susceptible to flipping that parabolic SAR and then turning the 20-week hole to the downside. And that combination, as you can see in the past, has always been at least an intermediate decline, if not eventually a correction, as we saw earlier this year, and then obviously too in 2022. Let's take a look at some of these oscillators, starting with the 3 green arrow chart. Here, let's go 3 green arrow chart first. We do have 3 green arrows all across the board. The Russell's the only one that's got the MACD with the red arrow. After being so bullish, remember, it's down 1% today. Everything else is still okay. In fact, the MACD for the S&P and the Qs are just, the momentum's just picking up. So, in fact, this is the strongest momentum for the Qs that we've had in the 3 months. And not the strongest for the S&P, but pretty much the strongest for the Qs. And it's been gradual, and it's been a nice move. And we've had pretty strong momentum for the Russell and the Dow. Neither one of them are showing any momentum right now, and we're just kind of grinding. But that's okay. They've been so strong. They've been catching up, right? They've been so strongly bullish relative to what we've seen in the S&P and the Nasdaq, and now they're starting to grab the baton and move and lead the way higher, which is what you'd want, right? That's the group you want to lead the way higher. All right, now let's take a look at the 2-line version of this chart. And we see we are, again, easily above all the moving averages. They're all rising. Everything is the MACD is above its moving average, hence the green arrow on the histogram. The stochastics is in bullish territory at the 90th percentile. So strongly bullish there with room to go. Like the MACD is like that 1% mark tends to be the upper limit when you're not coming off of lows, which we're not. We've already come off the low way over here. So we still have, a little bit of room to run to get as high as we were over here going into August expiration. Now we're heading into a week away from heading into a September expiration. Let's take a look at some of the other oscillators and see how they're doing. The DMI is still strongly positive. You're above 30, well above 30 on the positive indicator, and below 20 on the negative. The ADX is now back above 20, so you'll have light green shading going forward from here, just like this. You'll see that on Monday. So that's a positive sign for the markets. The RSI and the CCI are both at bullish levels. The RSI here, is still above 60, so it's still bullish. The CCI itself is still above 100, much less 0, so it's still at bullish levels as well, and so still strongly bullish across all these different oscillators. The Ichimoku cloud, you can see the trend strength indicator is now above 18, so it's almost above 20. Again, just for some perspective, like the last time it was above 20 was here in 23, 24. It actually got all the way up here to 23. But like again, right now, just for some perspective, let's change this to from 15 to 18 now that we've crossed that level. And again, we crossed 18 back here in February 24. Ultimately didn't peak until March. So still strongly bullish there. And that was the only other time in the last 5 years that we were above 18. If you go back to 2018, we got above 18 over here in 2000 at the end of 2017, and then we went parabolic, just strong parabolic move to the upside, and then that's the only other time besides over here in 2006, coming off of the last rate hike at the end of 2006. We didn't cut rates until over here, but even that didn't lead to an intermediate decline. It just led to kind of a sideways action. We didn't get our first intermediate decline until March, so still months away. So even though we're pretty darn high, it doesn't necessarily mean that we're so extreme that we have to drop like immediately, and that's obviously not the case. We are definitely mature, that's for sure. Very, very mature in this move. With the you can see it at 95 almost here on the noise balance down at the bottom. Rate of change is positive. The cloud's green, not very wide, but it's green. So looking pretty good there. If I take a look at the Bollinger Bands and the Keltner channels, you're obviously up above the band yesterday. And we're close to the band again today. The bandwidth is rising. The bands have moved, crossed outside of the Keltner channels today. So you have the green dot for the first time. Momentum is increasing. So really good sign from that perspective. So all bullish, all across the board. Again, not so parabolic. But also, but strong enough to have this trend. And again, very mature in this run, but we're currently on a pretty good run as we speak, pretty good near-term rally as we speak right now. Let's take a look at the intraday moves. You can see we did get a higher high and a higher low. We did not close above because of that last little drop we talked about at the very end of the day. We ended up closing below yesterday's high point. Well above the value area. The value area for the 4 weeks is way up here. So, there's an opportunity here for some weakness there from that perspective going into Monday and Tuesday. So that's something to keep an eye on. We're up in the after hours just a little bit, but something to keep an eye on going into Monday. Now, again, Monday and Tuesday are most likely going to be very, very quiet days. And if that happens, again, like you'll see more of a this volume note picking up, and there'll be a very big gap in volume below us, and I can see that being the case. I don't expect much movement until the FOMC meets on and decides next week on Wednesday when they make their policy announcement, and really the policy announcement itself is going to be widely expected. It's going to be what he says afterwards and how dovish or hawkish for that matter he is afterwards, and again, a dovish Fed is would be a good thing for the markets here. The market likes to have cuts on the table, and that dovish Fed keeps cuts on the table. Doesn't necessarily have to use them. Like if we can get 1 or 2 by the end of the year, like we've talked about before, similar to the end of last year, then you see how bullish that is, right? The market likes it when we have a few cuts and nothing more. But we have the cuts always on the table. Even last year after we ended those cuts, we had cuts on the table going forward from there. So, and so that the market loves a dovish Fed, a Fed that has cuts on the table and ultimately doesn't feel like it has to use them. Like right now, we don't have to cut in September. There's no reason to. There's a lot of public pressure and political pressure. And yes, the jobs market's showing some weakness because of revisions. But the reality is, like, the unemployment rate's not strongly higher. And the jobless claims outside of this week's anomaly, and it was an anomaly this week. It's not and we'll see if it's a trend next week, but there's some anomalous factors on this particular week of the year from a seasonal standpoint that makes it higher. And so most likely it's, there's not significant weakness in the labor market. So we're getting a cut just simply because, right? It's the more, you have it on the table long enough, you have to use it at some point to have some credibility. And I think that's kind of what the Fed is feeling like. They have to use it. All the other central banks are doing it. It's like all the cool kids are doing it, and now we have to do it too. And so they, I don't feel like the market feels like the Fed is cutting because it has to. The market's feeling like the Fed's cutting because it wants to, like I said, because everybody's doing it. And we might get a cut or two out of this. It's widely expected we'll get 3, but then probably nothing more than that after. And it'd be my expectation going into next year. So we might get a little bit of a decline on Wednesday into this gap. But I think Monday and Tuesday will probably stay around here and really bring that normalized ATR down to a really, really low level. If I take a look here at the range, at the trading range and the volume, very, very small. So the range is 2 points. The volume is at 72 million. When you look at that normalized number, we are below we're at 0.77%. And I think that will actually probably get a lot lower over the next 2 days, because I think we'll have continued small ranges and very low volume. And remember, the volume itself and the money flow is actually very strong right now, extremely strong. And that has in the past led to declines. The last 2 on this led to at least that near-term decline right here, and then more of an intermediate decline here. And so here we go. Like most likely we'll get at least some kind of near-term decline by the end of the week next week. Whether or not it turns into anything more than that, I don't think it will. I think it'll probably just move back down to the moving average. Maybe at worst get a bull tag again, and then most likely bounce off of that going forward. It's all going to be dependent upon what happens with yields. We'll talk about that here in just a second. Volatility finished at their lows of the week. A little bit of a ramp up at the end, but still below 15. Still, way closer to 80% than 85 even. And the VVIX still relatively high, with the correlation dropping. Not quite back below 75% yet, but working its way in that direction. And you can see not just the 2-week correlation, but the 3-month correlation is really dropping. Has been below 75% this whole time. And last time we got below 75%, it really led into a significant move higher in volatility. You can see the VVIX bottomed out and then started to rise before the VIX did, and then we really led into a big jump here. And it was mainly quite a again a 3-month correlation. So the VIX actually ended up with a higher low point. The VVIX at a lower low. So that's one of the big reasons why. And then boom, a big pop up to the upside. Here's the other way around. The VIX is a lot lower than the VVIX is. And so again, that generally leads to weakness in the markets, or like a jump in volatility. Again, probably going to get a little bit of a jump by the end of next week, but nothing big. I doubt we even get above 17 or 18. If that, and I doubt we even get too far. Again, similar to what we saw here, we won't get above 90% or 0.9% there. So I'm not saying the doom and glooming at all, right? You can have a 1 to 2% decline, and the world's not going to end, and that's probably what we'll see. Again, sometime towards the end of next week, as the market kind of sells the news on the FOMC announcement. All right, now let's talk about what's driving this price action. And again, like I said, yield's a really important thing to watch. Look at gold's really significant ramp up that it's had here in the last little bit. Again, as we've really started to price in pretty much 100% odds of that rate cut, gold's taken off like a rocket. Everything else has already been bullish. The dollar hasn't dropped over that time frame, but gold has broken out into this kind of parabolic run. Here is the gold contract on the DMI. Here, let's do GLD instead. Look at that big time move. The ADX is up above 25, and huge move on the positive indicator and a negative. Here, let's do GC, but let's take off those arrows because that's what's throwing off throwing off the chart here. Look at that. Huge parabolic run in gold. Like, you know, we're below 10 on the negative indicator. We're well up. We have been above 40. In fact, on the day that we were below 10, before we were above 40, like, this is a parabolic run, and we saw that over there. We actually saw a pretty good bullish move on gold last year going into the rate cut, but this is a significant. I mean, considering especially how bullish we already have been, you know, and that's on the daily chart. Here's the weekly. Look how parabolic the weekly chart has been since gold pretty much took off from 2,000 now up to 35, over 3,600. And that was just February of 2024, so just over a year ago. And of course, when you look at the monthly version of this, you know, it's about as parabolic as we've seen. Like, again, we go back, if I were to go back a little bit further, you can see, like, again, we are pretty parabolic over here as well. And then it just kept going, right? We had a straight run up from 262 up to 1,800 in a matter of, you know, again, coming out of going into the decade, the lost decade, so to speak, when the CAPE ratio was so high and gold took off. Well, here we go. CAPE ratio is really high again. Was high in 2021. That's when it kind of started. Like, you know, here's 19 into 20 going into, you know, coming through COVID there. But this is the big one, right? This is the huge parabolic. I mean, look how low that negative indicator is on the monthly chart, and the positive, of course. It's not easy to get the positive above 40, but I mean, that's a strong run to the upside. I mean, you look at the rate of change here. Here, let's go out maximum, and we'll go to monthly chart and pull up gold. I mean, just for some perspective, of course, back over here in the 80s, the late 70s and the 80s, you can see the big run. But since then, it's been, you know, this you know, the bear market decade, the double-barreled bear market decade of 2000 going to 2008, and then the credit crisis is where it ultimately ended up peaking there. And this is a 26-month period. But if I were to, let's see, how far have we been now? This has been 24 periods. So if I were to switch this to actual 24, you know, we're up almost 100% off of that low point. Again, closing at 1864, we're at 3680. So almost 97%. That is the highest level outside of the late 70s over a 24-month period. So, I mean, as strong as bullish as we were going into the credit crisis, and as strong bullish we were going before that, like, this is the strongest 24-month period. Again, it's only 12 days into September, so we'll see by the end. But this is the strongest run that we've seen, you know, in the case of 24 months. So that'd be 2 years, essentially a 2-year return. We haven't seen a 2-year 100% return on gold outside, again, of the late 70s and the 80s, going into early 80s. So it's a pretty historic move. And again, like, why is gold going up so much? Like, if you look at the 2-year return for yields, it's barely positive. Now it is positive. It finally has turned positive. The 2-year return for yield, or bonds, excuse me, have been very negative. But now here we are, September of 2012, and this is September 2025. This is September here of 2023. We close at 88.69, and right now we're at 89.95. So, and it's a pretty good month so far. I mean, this is, again, only 12 days into the month. And TLT is having an engulfing pattern, but again, crossing above. The last time it crossed above zero after being below zero, yields took off to the upside. You can see it crossed zero over here, and it didn't take off. It had a little bit of a pullback there, but then it took off again, crossed zero over here, and then it took off, like, it went parabolic there across zero right here, and it also took off in 2008. So yeah, like, it's turning up. The 2-year return for bonds is turning up. You know, that, you know, generally isn't the most bullish for equities. Gold's taking, you know, up 100% over 2 years, bonds turning higher, and then finally, if I were to take a look at the dollar index, you know, it's been down for so long, has been rolling over, and continues to be lower. If you take a look at the dollar index here on the daily chart, of course, strongly bearish. But if you look at the weekly version, again, we've been getting multiple clusters, and we're kind of out of, you can see the basing pattern that we've been forming. You see that happens, right? You see it happens quite a bit. You get the basing pattern, some kind of basing pattern, and then we ultimately rally, and that happens quite a bit. And we've been basing here with multiple clusters for multiple weeks and months. Again, the last time we had 3 clusters in a row, we had about a 4-week rally. It did not like take off. Well, we never did really get below those cluster lows. We did a little bit there, but immediately turned higher. And every other instance we got below those lows, we immediately turned higher. And then before that was these cluster lows. So I have a feeling that that we're setting a low point right now on the dollar, with bonds poised to start to move higher, and gold already like just parabolic, like the strongest run it's had. It seems like, with the skew as high as it's been, measuring that tail risk for equities, it just kind of shows that it looks like the market is a little bit more concerned. Other ends of the market are a little bit more concerned than what, the surface level on the stock market would suggest. And we saw that in the AAII sentiment survey, right? I showed you that. Let's see here. Let me bring up the AAII survey. I think I showed it to the class. I don't think I showed it on the Market Outlook last night. But 50%, not quite, it's like 49 something, but practically 50% of this sentiment survey says they're bearish. 49.5% of the people who took that survey say they're bearish right now. We have never been that low, near 50%. See all these other instances when they're less than. All these other instances when you've hit 50% or lower have been during declines, right? The fact that we are at all-time highs and we are on a strong run, 30% plus run off of the April 8th low, and of course a 27% run off the last 5% low, which was this little dip right here. That's a strong run. Again, all-time highs, as bullish as we are, and yet almost half of the survey's participants say they are not neutral, right? Which you would expect, right? Oh, we're strongly bullish, and I'll be neutral here. I won't necessarily be. I'm not going to be bearish, because you're never bearish on a strong rally. But I'm also not going to be like bullish either, because we're so mature in this trend. So I'll just say I'm neutral. Well, that would make sense, but that's not the case. They're not neutral. These are bearish, right? That's what 28% say they're bullish. 49.5% say they're bearish. So that is what 77.5%. So that means the other 23 or 22.5% say they're neutral. So that's the least out of both of these. That's the smallest, which you would think that would be the strongest when you're so bullish. Not the case. Like, we are generally like heading into correction or already in correction when both of these, the bulls and the bears, are below the historical averages. The bears have been below the historical average this entire time. Never did get back above it, no matter how bullish we've been. And in fact, instead of working our way up above the average like normal, like all these other instances, we've actually gotten worse over the last 6 weeks and gotten progressively more bearish and progressively less bullish. Which again is not normal, as you can see here. When we came off these lows, like, we were bullish for quite a while because the sentiment was bullish and not very bearish for quite a while. In fact, the net difference between the bulls and the bears at 20 points, again, that's typically that you don't typically see it below this 20% level unless we are in correction, right? Or quasi correction, like the end of 2023. They're in that level there at the very worst of it, no less. But like, we are like, you would think based off of that survey, if you were not looking at the S&P's chart at all and you were just looking at the survey results, you would very rightly expect, based off of past precedent, that the market not only is pulling back right now, but it's actually doing more. It's actually in a correction. Remember, a correction is an extended move below the 200-day moving average. Not a number of a pullback, right? That's media narrative because they're lazy and naive, and it's easy to print a definition. But real definition, a good technical definition from a technical analyst like myself is it's an extended run below that long-term moving average. In this case, a 200-day moving average. That's a correction. A bear market then would be an extended run below the 200-week moving average. So like, yeah, you would rightly assume and expect that we were in a correction. not just a 5% pullback. And yet we are at all-time highs with a cluster, a market forecast overbought cluster right now on the weekly chart on the S&P 500. So huge difference. And like I said, gold is going parabolic with the strongest 2-year return it's ever had, going back, I mean, for, at least for the last 40 plus years, 45 years. You have to go all the way back to the late 70s, early 80s. So you're talking like 40 plus years for gold to have the kind of return we've had over the last 2 years. And bonds have turned their strong 2-year declines into a positive number now. We are now positive. So everything is pointing towards like, this sense of weakness, and yet we have an overbought cluster on the S&P, and the Fed's going to start cutting rates, and the markets, expected to continue to bounce. Maybe a little sell the news, 1 to 2% decline, maybe by the end of next week, early the week after, but most likely going to continue higher. And we'll get a 5% pullback by the end of the year, most likely. But then we'll probably get a green tag with a pretty good number in it after. Like no one's expecting, and I expected the Fed only cut rates a couple of times this year. Now, if they have to cut rates every meeting from now to indefinitely, then that means we're probably that all this stuff is actually correct. Like the weakness in the the positive number in the bonds, the sentiment here on the sentiment survey, the strength in gold, which is like, why is gold doing so well? Because here we are, like one catalyst we talked about today that could really turn things around is like, what if we can't do these tariffs? And that's a huge source of revenue. And even with that source of revenue that the government has right now, we're on pace for the third biggest deficit that we've ever had from a government standpoint, outside of 2020, 2021, when we were coming off of, we are passing those big spending bills, and we were coming off of COVID. It was a COVID response. There's no bear market right now. There's no COVID. There's no economic shutdown response, because there technically was a bear market in COVID too. So we're at all-time highs. Like there should be no reason for our deficit to be as large as it is. But now you can kind of see why sentiment isn't as all cheery, hunky-dory as it is either, because of that factor. Let's take a look at the breadth. The breadth really pulled back today. So as strong as it was yesterday, big reversal today. So, we're back to 5. It's still positive. We're back to 5 here. When you look at the number of stocks above the 50-day moving average, it dipped back down below the average after a big jump yesterday. Number of stocks above the 200-day also dipped back down below its average after a big jump yesterday. Number of new highs dropped significantly lower, about cut in half. So dropped back to the average after a big spike yesterday. The breadth thrust here, when you look at that, it jumped up, right? Remember, this is kind of it's not a day-by-day thing. It's like a MACD. So it takes a while to turn up and down, but it spiked up here today, excuse me. The bullish percent index. Let's see here. Let's take a look at the daily version. It made a pretty strong move. Yesterday to get to 60, over the last week or so to get to 62 above the average. It stalled out today. So the breadth, remember yesterday's breadth, when we looked at the sector rotation, you think, everybody was talking about, the breadth looks so good and we're expanding. Well, remember yesterday's breadth was a catch-up trade and nothing more than that. It was a simple oversold directional bounce for the sectors that were so weak going into yesterday. All these sectors here rallied the most yesterday. That wasn't the case today. Today, communication services rallied, discretionary had a good run, and ultimately technology, which was flat today, ultimately finished the week, doubling the market's returns. And that's exactly what we want to see, right? We want to see technology lead the way higher. It will most likely not. It'll most likely show some, it's been weaker here recently. Here, let's go to this sector, this chart, and we'll look at XOK. It's been weak, right? But then it popped up on Wednesday with that gap higher. I don't think we're going to, and we got above the ratio. I don't think we're going to build on that. In fact, I wouldn't be surprised if we filled in that gap by the end of next week with technology. You can see there's some momentum here, but it already looks like it might be peaking without the relative strength being above 100. So I think that was just a short-term pop, and I wouldn't be surprised if the weakness we get will be because of, I mean, we already see it in Oracle, right? One of the reasons why it popped is because of Oracle. Well, Oracle, we talked about this in our class, whatever yesterday was, Thursday. We were just barely below the low point, but we talked about, like, it was engulfing. It was below the close, the open and the close, so it was below the body, and it was barely below the low point on Wednesday. But it's like, okay, if that engulfing pattern, like, there's a good chance that we fill in that gap, and we talked about it, a trade opportunity. In fact, I had a student today say that they made $18,000 already on a bearish trade that they made on Oracle because of that, right? They took that trade opportunity there, and most likely will continue to fill in, and that could very well be one of the catalysts from a technical perspective that leads to, again, some weakness in technology. And again, not Monday, not Tuesday, because the days will probably be flat, but especially on Thursday and Friday, once we get the FOMC and we get to sell the news, and then we'll see what the Fed ends up saying in their press conference afterwards. All right, so that brings us to our trade idea of the day. Let's take a look at Abbott Labs here. And you can see we got a bull tag just a couple of days ago on Wednesday, but a big down day there, and dropping back up. A big, nice reversal yesterday. The near-term line had crossed above 20 on Wednesday despite that drop, but then it went from 22 up to 62 with the momentum line above 90. So very strong near-term bounce yesterday, and then a nice follow-through today so far, closing above all of these all these closes here. Really only that one there that we haven't, but strong near-term rally. The near-term line crossed above the intermediate line. The intermediate line turned back higher again. So we have dark green shading and the green line. We're back above the moving average by over 1.5%. Let's take a look at some of these other charts. If you look at the weekly chart, the Hakinyashii candle, a nice good transition candle there. Again, we don't have a green arrow because we're already got the green arrow, right? But a nice close up, bullish close, long lower shadow tends to be bullish. Let's take a look at the 3 green arrow chart. Obviously, we have 3 green arrows today. The MACD and stochastics turned back up today, so that's a good sign for the stock. When you look at the 2-line version of this, we're back above all those moving averages, including the 200-day and the point of control. So nice, good move there. You can see the MACD and stochastics turning up and above average volume. The average isn't too strong, but it's above average volume there. If you look at the DMI indicator, you can see we got a bullish cross. They're still both below 25, but they're the positive indicators moving in the right direction finally. The negative indicator as well. The RSI and the CCI. The RSI jumped above 50, not quite above 60 yet, but the CCI did jump up easily above 100. It was above 150 at one point. It's like 170 before this late little pullback. If I look at the Ichimoku cloud, we are up above the cloud. The cloud is green. We're still above the cloud. We pulled back and tested it, but we're bounced right off of it. The rate of change is positive. We had a weak, that decline on Wednesday killed the weak bullish trend we had, but now it looks like we're potentially starting one up again. And then when you look at the Bollinger Bands and the Keltner channels, the band width is really low, but we ended up closing, despite the pullback again, we ended up closing slightly above the upper Bollinger Band, and then, with the band really inside the Keltner channel, so room really to run, and off the highs here, and opportunity to fill that range in and then some would be my expectation. So what we decided to do here was a bullish trade, of course, and did a long vertical spread at the 30 delta, selling the 140, buying the 135 for protection, and basically getting about a 1.5 to 1 reward to risk ratio, which kind of goes to show the probability of that trade. You're considering us a 30 delta, instead of getting like a 2 to 1 or 2.5 to 1, we're only getting a 1.5 to 1, which reflects a higher probability. The lower return reflects a higher probability of success. Again, who knows if the stock will go up, so we position size in case it doesn't, and we'll take a small loss if it doesn't. But if it does keep going up, and it doesn't have to go up very much, only has to go up to 140, and 140 is right there. So basically have to get back up to its highs and then some, and so we'll see how that plays out by the time we're done. All right, well, that wraps us up for today. You heard from me now. Now I want to hear from you. Scroll to the bottom of the blog post, comment on anything that stood out to you today. If you had any questions about anything I brought up or any questions about anything I didn't bring up, post those down there. You can also comment on the YouTube video as well as the Market Outlook tweet. My post at the top of my Twitter timeline at DavidSettle42. Again, remember this is a free Friday video, so if you're interested and you like these videos, you can get access to all of them every day of the week with our foundation tier. Again, at just $29 a month, you get access to everything you saw today, including the Market Outlook Live, which we do every day at 3:30 Eastern Time, where we manage all these Market Outlook trades that you just saw that we did on Abbott, and then also our trade tracker, where we track the results of all of our trades, so you can kind of see how they're going and track their value relative to whatever benchmark you use and relative to the cost it takes to get access to these trades. So again, thank you for watching. Have a great rest of your weekend. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video, share it with others. Follow me on Twitter, follow me on Facebook, LinkedIn, all these social media accounts. Like our content there as well. Again, have a great rest of your weekend, and we will see you all on Monday.